The Dutta chart is out there, Neil, and it is finally, we have legitimate real income growth. Will we sustain that?
I believe so, Tom. Thanks for having me on. Obviously, there's a lot of disinflation in the pipeline, at least over the next, you could say 3 to 4 months. The most obvious is used cars. We know that wholesale auction prices have been coming down. That's going to bleed into consumer prices for used cars and trucks. Supply chains are improving. That's going to take some pressure off of core goods outside of vehicles. And there's still some disinflation in train with respect to shelter, looking at new lease growth. At the same time, we know the labor markets are holding up, and that's going to support real incomes. And if real incomes are rising, ultimately, I think consumers are going to go out and spend that money. So I think that's sort of the linchpin for why things are holding up better than expected.
Atlanta has a GDP now numbers. We came in at a 2% statistic Q1, and all of a sudden we're migrating 1.82-ish on Atlanta GDP, whatever it is. I really don't care what the number is. But my question is, to the gloom, what statistic of positive GDP in America is a so-called growth recession? Is it 0.5%, 0.5? Do you have that number in your head?
Well, I would define a growth recession as a situation where the economy has the GDP has a positive sign in front of it, but that growth is not strong enough to keep the unemployment rate from rising. So typically in a growth recession, you'd see the unemployment rate go up. So it's effectively a below potential growth state, Tom. But that's not what we have right now. I mean, you mentioned the Atlanta Fed. That number is tracking 2.4%. With very little contribution from consumer spending. I suspect that probably builds over the summer, frankly. But
wow.
But look, there's more upside to the economy than not. But we're growing above potential, and that means that whatever unemployment rate increase you see, sort of bobbing around 3.5%. I mean, it's probably going to be short-lived. We're not on a situation where we're going to see above 4% unemployment.
Goldilocks seems to be the moment that we're in. That's what a lot of people are saying. How long can Goldilocks last?
I mean, talk to me in the fall, Lisa. I mean, that's what I'll say. I mean, I think I'm sort of in the Goldilocks for now camp. I mean, I do think that there are reasons to be somewhat suspicious about how long this can last, about whether this is a durable, sort of sustainable moderation in inflation. I think that's a question that needs to be answered. I don't think we can answer it just yet. But, to me, when you think about economic scenarios, I think the risk of recession has receded dramatically. And so now it's a question for investors about where do you put those other percentages, right? I mean, I think the markets are right to kind of allocate a little bit more to the soft landing story. But I think, I think you can make a good case that maybe we're getting a little bit over our skis here, and we should probably put some more potential on the resurgence of the inflationary boom scenario.
Okay.